Welcome to The Close. Thanks for joining us today. I'm Morella Fernandez. Markets close in an hour's time. Let's get to the stories we're following out of the BNN Bloomberg newsroom. Canadian oil stocks are plummeting today after U.S. President Donald Trump pledged to revive Venezuela's energy sector following the capture of Nicolas Maduro. Now, different story in the U.S. where oil stocks are trading higher. Chevron, ExxonMobil, ConocoPhillips are surging on expectations of that expanded access to Venezuela's vast oil reserves. Trump says U.S. companies will invest billions to rebuild the country's crumbling infrastructure. Now, in New York, Maduro has pled not guilty to U.S. charges in a narco-terrorism case against him. He was escorted in front of a federal judge in Lower Manhattan to face the charges today, a first hearing in that criminal case, kicking off a legal battle that could take months or longer before he actually gets to trial. U.S. gold and silver are also climbing with the capture of the Venezuelan leader, kicking up more concern about geopolitics. Gold coming off its strongest annual performance in decades, supported by central bank buying and expectations for more U.S. interest rate cuts. Shares of Minto Apartment REIT are surging today. Crestpoint Real Estate Investments has agreed to take the Ottawa Trust private. The deal values the firm at over $2 billion, with Crestpoint opting to buy majority control of the apartment REIT at 18 Canadian dollars a unit. The remaining 42.7% of voting interest will be retained by the Minto Group. And here is where we are on the markets at this hour. The TSX Composite up 402 points and set for a new record high at 32,285. Let's go south of the border. The S&P 500 moving up 44 points, 0.6%. The Dow Jones, a 705-point move up today, 1.4%. And the Nasdaq, 144 points up so far, 0.6% on the day. So following the capture of Venezuela's leader and the U.S. president's announcement that the U.S. will take control of oil production in Venezuela, alarm bells are ringing in Canada's oil sector. As the largest supplier of heavy oil to the U.S., is Canada's dominance now under threat? Let's go to Patrick Horan, Principal, Algalith Capital. Thanks for joining us today.
Thanks for having me on.
So does this change of guard in Venezuela, you think, pose a serious threat to Canadian oil producers?
No, I don't think it is. If we were at $100 barrel of oil, I think it would be a threat. But right now, there is quite a bit of lapse in the infrastructure in Venezuela. So there is going to be, what I've heard, $100 billion of investment needed. And let's put it in perspective here. If they triple their oil capacity, we're looking at basically 3 or 4% of world oil supply. So it really isn't that much, and it will take a long time. Now, the one thing with Trump, when he does something, he likes to claim victory right away. He likes to talk about the long-term outcome, but seldom, if ever, has it ever been an easy story watching it actually all unfold the way his projections think. He just likes to plant the flag and say, it's done, it's great, whatever. And I think that's the case here. If anything, if I was a shale producer in the States, I would be worried because they are really on the margin, the marginal producers. So if Venezuela does get involved in a very, active way, and say probably 2 or 3 years down the road, the marginal producers will be the ones that get hurt.
Okay. Let me interrupt for a moment because you mentioned that infrastructure is one thing that could hold back Venezuelan production, but they also have reserves already on hand. So two things. Are the reserves a threat as far as providing a great output into the global market? And what else could hinder the ramp up for Venezuela into producing more?
Well, I mean, there's, when you go and basically invade a country and hold the president accountable for. I don't know if these crimes are real or not. Um, you open Pandora's box. How many well-intentioned invasions have happened, uh, primarily from the U.S. that haven't worked out? So Vietnam, Iraq, in Afghanistan, it goes on and on. People do not want the tyranny of rule from afar, and so I would be very skeptical whether this works out the way Trump is trying to portray it in his playbook. It's Pandora's box really right now, and you really don't know what's going to happen. Is Exxon and Chevron, logical companies to reclaim the assets that were taken from them? Absolutely, 100%. But they have cost discipline or capital price discipline, and they've shown that. I'm kind of hard pressed to think why would they go in and invest more money at $50 a barrel? It's got to be much higher. So I think
not
what
only
we're
that,
looking.
not sorry to interrupt again, but not only that, but they would have to have a sustained American military presence in Venezuela for those American firms to be guaranteed operational. Even then, there would be risk.
For sure, for sure. So I think we have so many different factors here to play with. But what I think ultimately happens, I mean, we probably won't see $100 barrel of oil. Venezuela will come on stream probably very rapidly if that happens, because there'll be a lot of interest to get it to market. But right now, where we sit, I just don't see it being a threat.
Okay, so given the situation that changed on the weekend, are you making any changes to where you're putting your oil investment money?
Yeah, so to be clear, we actually don't invest in oil, even though I'm speaking a lot about it. We invest in the peripheral market, so the drillers, gas compressors, so like Precision Drilling is a name, Enerflex is a name. So we'll produce or we'll go into the tool makers for the gas production, and we don't see any change there. And if anything, I didn't add any this morning or today. If anything, if there's further weakness throughout the week, I would look to add here, because I really don't think there's much to do about this. Not over the next couple of years.
One other question. We talked about sort of immediately Venezuela not really gaining much because there are so many things that could hold them back in the near term. Longer term, do Canadian oil producers need to worry, 1 or 2 years down the road?
I'm assuming we get another pipeline built. That probably comes on stream probably the same time, the improvement in their infrastructure comes on stream. I kind of think it's a tie thing. It just means more diversity for Canada, more diversity for Venezuela oil. I mean, the U.S. we've got pipelines going to the refiners. The refiners are further up north. I mean, the U.S. has really weaned itself off of Venezuela oil. There has to be, and you also think about it. I mean, the Western Canadian Select is already discounted. It's discounted like 20 to 15% from WTI. Like it's already discounted. So I don't see the logic here that Venezuela is truly a threat. Oil is a very fungible commodity. It gets spread around the world. It is just not one versus the other. It comes in, it overflows, it gets deposited all over the place to the highest bidder. So anyway, I don't think this is really anything but a blip in the market.
Okay, very quickly, under a minute if you could, are there 1 or 2 investment ideas you have outside of energy or oil?
Yeah, well, we continue to like value, and the market's is definitely agreeing with us. You just saw them today. The U.S. was up, Canada was trailing. And that has flipped around throughout the day. So with value, Canada's value, the US's growth, I think you really want to be in value. From our standpoint, the easiest value stocks are still the insurance companies, the banks, the investment managers in Canada. And they're, the AGF and IGM, they're working for us. Those are our two workhorses on the investment management side, and they're working for us really well, as is Manulife today. So those are safe ideas. They will go up. They should, kind of keep pace with the market. Gold is going to be a very difficult thing if we don't own gold, it's not our bailiwick. So I can imagine the TSX is going to be hard to catch over this next year if gold continues to do what it's doing, because it's getting to be a much bigger weight. It's going up really fast, and it's going to make my job of outperformance really that much more difficult. So that's my challenge.
Got it. Patrick Horan, got to leave it there, sir. Thank you. Appreciate you joining us on the program.
Okay, thank you. Bye now.
Coming up, a deeper look at the hit on the Canadian oil industry after the weekend capture of Maduro. Back in a moment. The U.S. president says he's taking control of Venezuela's oil industry, but what can he do with it? For a deeper look at how that is affecting oil today, we were joined by Rob Barnett, energy and commodity research at Bloomberg Intelligence.
We put out a note this morning, making the case that, there's some long-term risks to think about when you're thinking about the Canadian oil patch. But I think most of these things will take, billions of dollars investments and years to materialize. And, you've seen oil pretty flat this morning, despite all of the news. And I think that the possibility of bringing lots of heavy crude back to the market from Venezuela is very real, but don't expect it overnight.
And do you think the oil companies are going to have the stomach for this? I mean, two of them already got burned 20 years ago, 25 years ago. Are they ready to go back in?
Yeah, I think there'll be some interest, but I do think that it's not going to be just a panacea. This is a kind of thing where, sure, there might be some increased interest. It's very hard to ignore the largest oil reserves on the planet that Venezuela has. So I think that there probably will be some companies who would be willing to take that risk to enter the market and bring those resources. But I do think that it's not a slam dunk. It's not automatic. It's not overnight. So I think probably all parties are going to proceed pretty cautiously. And, you got to keep in mind the near-term picture for the oil market is that we have excess supply. So probably most companies are sort of in a mindset where they're, keeping their capital budgets pretty tight here at the moment, given that we've got excess capacity, at least here in 2026.
Okay, and you mentioned the impact on Canada. Short term, probably not too much, but they should start planning about something potentially happening there.
Yeah, I think this could reshape a little bit of the North America energy landscape. So, as anyone in the Canadian oil patch knows, the relatively captive to the U.S. market because of the integration with pipelines and refineries there in the U.S. If you theoretically get more Venezuelan barrels on the market at some point in the future, that's a net negative for the Canadian oil producers. It potentially widens the discount for WCS relative to WTI. It probably puts a lot of pressure on Canadian policymakers and the companies in the oil patch to think about additional pipeline capacity that avoids the U.S. at some point.
And with that oil pipelines, would we see them go east as well, along with west?
I think the politics of going east is probably more challenging. Not that the west is easy, but you certainly have a longer path there, and that's a lot of negotiation to find a way to market if you take the eastward path. So Let's see how it evolves. My expectation would be that you're more likely to see more thinking about additional options beyond the Trans Mountain pipeline, that sort of thing.
Rob Barnett is energy and commodity research at Bloomberg Intelligence. Coming up, we will look into the oil markets with CIBC's Rebecca Babin. Back in a moment. Oil prices rose today after rebounding from a brief decline as traders assess the limited impact of reduced Venezuelan supply in what is considered to be an already oversupplied market. Let's go to Rebecca Babin. She's senior energy trader at CIBC Private Wealth and joins us now to talk some more. Thanks for your time.
Thanks for having me.
Okay, oil prices up, but a limited move here, despite the Venezuelan supply being off market, I guess. What does this indicate about the need for the product from Venezuela?
So I think what the price action today indicates is two things. And the first is that positioning coming into today was extremely bearish. Managed money for Brent shorts was at a 10-year high, whereas WTI longs were at a decade low. So we're seeing a reaction and we've seen increased uncertainty. I think if you listen to everyone talk right now, we're not hearing about a defined plan, and we don't exactly know if we're going to see an increase in Venezuelan crude in the short term or a decrease. And when we have increased uncertainty, if positioning is extended, traders are going to unwind that position. So in this case, that's a cover of a short. I don't think the market's telling us that we're going to see a massive decrease in Venezuelan supply in the short term. You know, they were only producing 900,000 barrels a day of crude. We'd already knocked off around 300,000 barrels leading up to this event with sanctions. We could lose another 200,000 to 300,000 barrels in the coming weeks. But in the context of a market that's oversupplied by over 1.5 million barrels a day, that's not enough to force prices higher. So it's really, I think, a positioning-based rally at the moment. And secondly, maybe just a turning up of the heat of geopolitical risks broadly, right? We have protests in Iran. We've had some headlines from Netanyahu regarding Iran rebuilding their nuclear capabilities. And so this isn't happening in isolation. We also have China and Russia, who are direct investors in Venezuela, and we need to see how things unfold with them. So I think this is uncertainty, geopolitical risk, and positioning, because we are a well-supplied market, and losing 300,000 to 500,000 additional barrels isn't enough to create a sustainable rally.
As you know, the U.S. president wants American companies to come in, rebuild some of the infrastructure. He puts it as sort of reclaiming the debts that they are owed. What challenges could American companies face trying to rebuild in Venezuela?
So there's several challenges, and the first is just the amount of investment it would take to get there. Now, if we talk about this, we should talk about it in two tiers. The first, like 500,000 to 1 million barrels of increased output in Venezuela that would come in the neighborhood of 1.5 to 5 years, isn't as big of an investment as when we talk about increasing production back to that kind of 3 million barrel a day mark. So if that first 500,000 barrels really comes at an investment of around $15 to $20 billion over 5-7 years, which may be manageable. You're looking at reinvesting in existing infrastructure and reworking supply that way. If you want to talk about that next tier of supply, getting back to 3 million barrels a day of production, and that is a 5 to 10 year time horizon, you're looking at investments of over $100 billion. Last year in 2025, U.S. production cost capex of around $60 billion. So it's a big number. So that's the key and number one kind of challenge of going back into Venezuela, is just that cost. The second is the clarity. These are long-term investments. How do you know that you're going to have sustained consistent laws, regulation above the ground to make that type of investment? And that's, I think, the second big barrier is how do you get that confirmation of long-term stability?
Okay, and if you're a big oil producer in the U.S. and you're invited by the Trump administration to do it, saying that they will support you, would it be worth the risk? At what point would it be worth the risk?
So that's a really good question. And it's going to be worth the risk when the return on investment from making that investment is greater than the return on that, putting that CapEx dollar into a different project, right? So when we look at the back end of the crude curve right now, it's not falling apart. It's not that much lower based on a potential of increased Venezuela supply, because U.S. companies have been so capital disciplined that the traders are looking at this and saying, okay, if that CapEx dollar goes to Venezuela, does it mean it's taken from somewhere else? And it's going to be that return on investment that drives that decision, and confidence in the stability of the laws and regulations in Venezuela. So it's also going to require some confidence of crude being kind of in the range of $60 to $70, and not kind of closer to the $50 or $40 level. So there's a lot of factors. And I think the reason that we're not seeing the back end of the crude curve fall or respond to this is that there's just not a tremendous amount of confidence that that dollar goes to increasing Venezuela crude in a 10-year time horizon with this much uncertainty.
Okay.
We could get more information that changes that, but right now, traders aren't willing to make that bet.
Is this a concern for shale producers in the U.S. Longer term?
Sure. Yes. In the very long term, if it's a perfect world and we do get the laws and regulation in Venezuela and it makes sense to put that dollar there, it's going to increase production in that scenario. And that would drive crude lower, and shale producers would then be priced out of the market. They're looking at break evens closer to $50. Break evens in Venezuela obviously would be lower once those investments have been made. So it would pressure that. And I think you are seeing that in the equities today. You're seeing a bifurcation of how equities are responding. Some U.S. producers are lower, oil services are higher. So you're starting to see a little bit of that bleed into the market. But I still think in general, the crude market is taking a very conservative approach to pricing in additional barrels.
Rebecca Babin, got to leave it there, but thank you for your time. Thanks for joining us on the program.
Thank you.
When we come back, we'll get a portfolio manager's take on what Trump's action in Venezuela might mean for your portfolio. Back in a moment. Canadian energy stocks under pressure today after the capture of Venezuela's leader, Nicolas Maduro. Let's talk about what it means for the energy sector and for your portfolio with Sam LaBelle, portfolio manager, Veritas Asset Management. Thanks for joining us today.
Thanks for having me.
We see investors abandoning some of the oil stocks already. Are investors jumping the gun with concerns about future exports of Venezuelan oil?
So I think there is a bit of an overreaction here. If we take it a little bit slower and look at the actual possibilities here. There was a period in September of 2024 when Venezuela wasn't exporting at all to the U.S. and it jumped. They eased the restrictions. It jumped from 0 barrels a day to about 315,000 barrels a day from the period of September 24 to January of 25. And so we have kind of an experiment here where what happens when the Venezuelan oil comes back on the market? At the time, crude oil was in a bit of a retreat. It went from an $80 price down to a $60 price from September into the early Q1 of the next year. So that wasn't just the factor of bringing on new Venezuelan oil, but we did see an effect where the differentials, so the Canadian producers with their heavy oil face a differential because of the quality and the extra work that it takes to process heavy oil. And that's known as the differential, the heavy oil differential, and usually measured against a benchmark called Western Canadian Select. So in that period where you had Venezuelan oil going from about 0 to 315,000 in a very short period, what ended up happening is WTI did come down quite a bit, dropped from $80 to $60. But the differential, what you were earning as a Canadian producer, dropped by far less. In fact, it actually narrowed from 13 to 10. So this time around, we're starting from a place where WTI isn't very strong. In fact, the forecast for next year was only $55 US for WTI. Differentials are somewhere around $13. So The problem here is that if you lower that $55 oil price, that $55 oil price is already tied to about 100,000 barrels per day expected decline in U.S. production. So you can't lower that price much lower without also impacting U.S. producers in terms of shale output. So there's kind of an unintended consequence. If you want to bring on Venezuelan oil, you might actually be hurting North American shale producers because the WTI price would see some pressure.
Okay.
And there's also a price where if you reduce it low enough that you'll actually see production contract in North America. So there's
given that,
there's a bit of a safety valve there where if we're not going to see a flood of Venezuelan oil because the infrastructure is in really bad shape. It was at 160,000 barrels a day as recently as December. Getting back to 300, that's kind of within a reasonable ballpark. But that extra additional oil, that might come out of every other heavy grades and other more challenging grades. For example, like Iraqi oil was 230,000 barrels a day in December. These are grades which would be replaced by Venezuela potentially. And also, it doesn't necessarily make logical sense to send the Venezuelan oil back into a well-supplied U.S. market where the refineries already have supply. You might still see the Venezuelan oil being exported into Latin American refineries, for example.
Okay, so given
not
that,
not a rapid build-up, not a rapid impact. And I look at the December WTI price. It's not even down today.
Okay.
So the market's not even anticipating that it'll hit this year.
Given that, what would you do with your oil investments, if anything, at this time? Are you picking up more because it's trended down today? What would you do with your oil investments?
So already I'd say the enthusiasm for oil was pretty low, momentum pretty low coming into the year. The forecasts were not particularly exciting at US $55 oil. So we came into the year underweight producers in general. We liked the pipelines. Pipeline demand continues. The oil still has to flow. There might not be as much growth and supply, and therefore as many opportunities for growth on the top line for some of these oil pipeline companies like Enbridge or TransCanada, TC Energy now, or even SOBO, South Bow. So we still like the pipelines. We think that that's maybe a little bit oversold. CNQ is a name that we hold that doesn't have the refining capacity. You might be wanting to transition to something like a Suncor because Suncor can buy the lower priced intermediate oils like WCS and refine them into final products that will continue to hold up in pricing, we think. Final products are priced off of WTI. So a transition to some more integrated names like a Suncor from maybe a Canadian Natural does make sense, but we like Canadian Natural. It's a long-term, well-invested company that has grown production. We think it can manage through this. It also has a gas component. We like natural gas-weighted producers here because gas is coming off about 350 Henry Hub last year. That's expected to repeat for this year. And the AECO price was extremely depressed last year and could rebound. So liquids-rich natural gas producers, for example, Tourmaline or ARC Resources, those are names that we've liked, and we think the valuation is very attractive, and it has the potential, on the gas side at least, to pick up any of the slack that might appear in the light oil side of things.
Okay, outside of energy, are there other sectors you're looking to at this time that are interesting to you?
Well, the big question when you're trying to make a forecast for the Canadian market is if you can forecast oil, which we're doing right now, and you can forecast banks and financials make up about a third of the index. Energy together is 15% coming into today, probably a little bit lower today. And then materials is the final piece, which is about 13%. So if you, about 18% right now. So you put those all together, that's 2/3 of the index. We're still bullish on materials names. We hold a number of gold producers. We like the fact that the gold producers are remaining disciplined in their capital investments this time around. They're not aggressively pursuing M&A or new mine construction, and they have some mines in the pipeline that are coming on. And as those mines come on, it often helps with lowering their producer costs as they add additional grades and volumes. So we like the gold names. We continue to own Hudbay, Newmont, Agnico Eagle, names of the kind of higher quality with some additional growth. And we like Barrick. There's been some activist investor interest there.
All right, Sam, got to leave it there. I'm out of time. Thanks for your time. Appreciate it. Coming up, where do economic policy and national security overlap when it comes to Trump's actions in Venezuela? We'll get into that in a moment. Former U.S. Commerce Secretary Wilbur Ross says there's a lot that can be improved in Venezuela after the capture of President Maduro. He joined our Bloomberg colleagues today.
Well, I think it's clear that a lot can be done and should be done to change the economics of Venezuela. Let me give you a few data points. They probably have 300 billion barrels of oil of proven reserves. At $50 a barrel, that's $15 trillion of reserves. So in terms of being able to handle the debts that they have, which are substantial, but are only 160 billion, so compare that to oil reserves well into the trillions, it should not be that big a problem. The bigger problem is that because of poor management, poor maintenance, and running out of parts, the oil production has gone down by more than 2 million barrels a day. At $50 a barrel, that works out to about $37 billion a year cost to the economy. Those are huge, huge numbers, especially when you consider the whole population is only around 27 million people, because some 7 million people have fled the country under Maduro. And it's not just oil. There's a lot else that can be fixed. For example, agriculture is 25% of the land mass of Venezuela, but it's only 3% of the economy and only 10% of the labor force. And the reason for that is that they don't have fertilizer. Their equipment, tractors and reapers and things are pretty well broken down. They need spare parts. So there's a lot of stuff that can be improved and improved pretty quickly. Agriculture, for example, could be brought back very, very fast. Venezuela had been one of the most verdant soils in all of Latin America, and it was one of the reasons why Venezuela was as popular and as prosperous as it had been.
But Wilbur, what needs to happen?
They were bringing Colombians in to help on the fields because they didn't have enough workers.
Can I just break in, Wilbur, and ask, this is your specialty. You made your name before you ran trade policy for commerce at the cabinet level, negotiating for creditors in the biggest names of bankruptcy, TWA and Texaco and Drexel Burnham Lambert. Then you obviously became the biggest restructuring expert, or one of them in the U.S., with turnarounds of massive businesses like U.S. Steel. So this is what you do. What needs to happen for capital to go into Venezuela and do the very same? What kind of stability, what kind of rule of law, what kind of prerequisites need to be met?
Right. Well, there's a lot that needs to be done. In terms of laws, Venezuela has the weakest property rights laws in the whole world. So that has to be fixed so that you have some assurance of private sector continuing ownership. But I think realistically, companies going in now in a relatively complex situation are probably going to want guarantees against expropriation. And that's not unusual. The U.S. and multinational entities often give expatriation and foreign exchange guarantees. Now, the debt structure is mind-bogglingly complicated. They have about 160 billion of debt altogether, counting expatriation claims, counting funded debt, counting debt for oil, counting everything. Those bonds have been trading in the high teens, low 20s. They could probably be restructured in the 30 to 40 cents on the dollar. So in the overall context, that's not a very big number. And one of the few good things is that the IMF has no exposure to Venezuela, and IMF is entitled to lend up to $50 billion. So they could very well be a source of some funding.
If I can just jump in on that point before we continue, Wilbur, because some of the exposure we do understand comes from China and debt owed to Chinese banks, for example. If there is a restructuring of debt in the country, do you expect the U.S. to exert force of who gets priority in the capital stack? Does it change where back payments and different restructuring comes from, just given the geopolitics of the moment between the U.S. and China?
Right. Well, both the Chinese and the Russians had made loans to Venezuela that are payable at least partly in oil, but oil at very, very advantageous prices to them. So they are part of the problem in that they're getting oil very cheaply out of Venezuela in return for debts that otherwise are never going to be paid. Now, the oil that comes out of Venezuela is mostly what we call heavy oil, and that requires a slightly different refining process from the American shale oil, which is mostly light oil. Both China and India have very strong facilities for processing heavy oil, because a lot of the Iranian oil that they had been getting also is heavy. And in the U.S., there are a number of refineries in the southern part of the country, particularly the old Citgo refineries that were established from the very beginning to handle this oil. So while it is a little bit different and it's a little more costly to refine,
right,
at anything like $50 a barrel, it's still going to be very, very cheap.
Wilbur, can I just ask?
The extraction costs in Venezuela, once you've got it up and running and with proper equipment, are going to be very, very low.
Can I just ask, Wilbur? We've only got
other natural resources.
We've only got a minute left here, and I want to ask.
Venezuela has lots of gold,
right,
most of which is not being used for lawful purposes.
Well, speaking of lawful, I just want to ask.
There have been transport planes every day flying to Iran with Venezuelan gold.
Fair. We've only got a minute left, and I just want to ask you about the precedent risk here. Does removing a sitting head of state on criminal grounds create a precedent that we have to live with later? Do other great powers now reserve that right for themselves as well?
Well, the whole situation is very complicated. I'm not close enough to what's happening on the ground to figure out exactly how to resolve the political issues. But Secretary Rubio has indicated on other television shows over the weekend that perhaps the ultimate solution to the governance of Venezuela is new elections. And if they're properly supervised, that might well be an answer.
Wilbur Ross served as U.S. Commerce Secretary in Trump's first administration. More to come. We're back in just a moment. Canada's Definity Financial has purchased the Canadian operations of U.S. insurance company Travelers. We spoke with Definity CEO Rowan Sanders about that deal today.
Definity is a publicly traded insurance company. We used to be a mutual insurance company called Economical Mutual. We went public in 2021. And now we're the fifth in the top 5 largest P&C companies in Canada. We insure about 70% of our revenue is personal insurance. So that could be your homes, your cars, your cottages. And 30% is commercial insurance. So that ranges from small businesses all the way up to specialty products and large corporate Canada.
What about travelers piqued your interest?
Well, partly this goes back to the whole reason for demutualization. We wanted to be a leader in the Canadian industry. So we're building a Canadian champion in P&C industry. And as such, we wanted to build our business and become one of the top 5. When we started as a public company, we were number 8. We organically grew to 6. And now with Travelers, we'll be number 4. But really what it was, this is a good Canadian franchise long-term. They have about $1.5 billion in revenue, 1,500 very talented, experienced employees. And for us, it gave us scale in personal insurance, but also access to new products and expertise in commercial lines. And that really broadens out the proposition we can offer our customers and we can offer our broker partners. So we're delighted. And this is really a transformational moment for us.
It is transformational and takes some time to maybe kind of figure out the ins and outs of buying a company like this. Like, how do you plan to manage the integration of it all?
Well, we've been planning quite a lot. And in fact, we've had about 600 people on both sides of the business working on this for the past 6 months whilst we went through the regulatory process. What we will be doing is we'll be transferring about $1 billion of personal lines business off the Travelers legacy platforms onto our platform. It's called Vine. It's a brand new, modern, leading industry platform. We'll be rebranding the products as they kind of move over. And then we'll do the same thing for the commercial insurance business, as well, working with the broker partners. But day one, we're still in the marketplace, the front lines, business as usual, serving customers and writing new businesses, settling claims.
Is this, do you think, like a tipping point when it comes to consolidation within the insurance industry?
I think it is. Our view and our thesis here is that we've built a company that can grow organically at about twice the rate of the industry. That's how we've been gaining share. But we also believe that the Canadian property casualty industry will consolidate, much like many of the other sectors in financial services. If you think about the concentration in the top 5, 6 banks and what's been happening recently with more bank consolidation. If you think about the life insurance industry, which is quite consolidated, we believe, and our thesis is more consolidation is going to happen. And I think Travelers is a really good example of that. This is a large, successful U.S. business that had a sizable Canadian business, but they felt at $1.5 billion they were subscale, and they didn't have the scale to fulfill their ambitions and compete effectively in the Canadian marketplace, which is how come, when we approached them, we decided to put the two companies together.
Obviously, AI, tech, and data technology, like all of that's kind of in every sector right now, in every industry. How are you kind of using that to help your business continue to grow, particularly with this buy as well, this deal? Well,
firstly, what we did is we've recently modernized our whole technology platform. So we have brand new technology, and those platforms really allow us to be very efficient. They allow us to interact directly with our broker partners, make it easy for customers to deal with us. In one of our brands, 5 questions, 5 minutes, you can buy a policy. But also AI is a really big investment. We've been using AI for well over a decade, but now with the new generative AI, we've got 275 practitioners in the business. We're investing heavily in it. We use it in all parts, from customer acquisition to retention to identifying, fraud management to help with pricing. It's going to be significant for us, and I really believe that as you move the business from Travelers onto the Affinity platforms, when we put through our models, our AI-supported, capabilities, and the digital platforms, that's a big part of the reason how we get $100 million a year in cost synergies out of the business. And so this is why this is good for our investors. We will be able to run that business about $100 million plus a year better than it's been run today on the more modern platforms. It's great for our brokers because we've got a broader product suite, to offer them. And the Travelers employees are actually very excited to be joining a Canadian champion.
You mentioned, okay, so you went through the benefits for investors then, particularly with that kind of revamp of your digital platform. How long do you think it will take before investors kind of see some of those benefits?
Yeah, when you put a company like this together, this is 2 pretty sizable companies. It takes about a good 2 to 3 years to fully get those benefits. Right. So what actually happens with us is we put the companies together. It takes about 1.5 years to 2 years to fully convert the business. And then once we have triggered those cost savings, they will come over a 3-year period. And roughly, there's about 1/3 of the benefits that come in the first half, and the other 2/3 come in the second part of the integration platform. And those are the cost benefits that I'm talking about. There are other benefits that I think will manifest as well. Travelers was not able to grow the revenue. It was pretty flat line for the last decade. With our bigger platform and our capabilities, we think we could get revenue synergies. And we think that there'll be some loss ratio improvements as well, particularly as you put some of the regulated product lines onto a more modern and sophisticated underwriting platform. So those will come through a little quicker.
Just lastly, given your answer a few moments ago about how you think that you are going to see more consolidation within this industry, within this sector, do you see more mergers and acquisitions within your future in the next couple of years?
Yeah, I think that's our plan. I think what we've said to investors is, look, we're a capital deployment strategy. One of the financial benefits of this transaction was that we had excess capital and we had a completely unlevered balance sheet, no debt on our balance sheet, coming in as a mutual company to a public company. This allowed us to deploy that excess capital. And we've also issued a $1 billion bond to help fund this deal. Two terms, 2 tenures there, about 4% yield. So taking advantage of low interest rate costings. So that's been helpful for us. It's been very well received by investors. Our investors fully supported. And in fact, these were heavily oversubscribed raises and transactions. And the story for us is we will continue to look for further deployment opportunities to consolidate. We built a platform to allow us to be a bigger business, to be able to be one of the top 3 insurance companies in Canada. So our strategy is to keep growing organically, but also look for further acquisitions. And our thesis is that, it'll be harder to compete and to deliver what your customers need in this evolving world without size and scale.
Coming up next, the closing bells on Bay Street and Wall Street. Here are the closing bells for the end of the trading day at the NASDAQ. Apexi Inc. ringing the closing bell. In New York, Thrivent Asset Management ringing the bell. You're watching the close on BNN Bloomberg. I'm Marella Fernandez. Here's how we ended the day on Bay Street and Wall Street. Here is where we ended the day for the North American markets. The TSX Composite up 336 points, more than 1%, for a new record close. 32,219 is where we landed. The S&P 500 43-point move up, 0.6% to 6902. And the NASDAQ moved up 160 points today, so 0.7% to 23,395. Let's get to the movers, and we start in the red. At the basket, oil dropping today at 53 cents or $7.42 to end the day at $6.61. This has everything to do with what's going on in Venezuela, with Washington saying it's taking over the oil reserves and the oil industry in that country. Moving on to Parex Resources, it is down as well, 5.3%, losing 99 cents per share. Canadian Natural Resources also down today. It dropped over 6%, losing $2.84 a share and taking it to $44.28. Headwater Exploration is also down over 5% today, a 48-cent drop per share, taking it to $9.06. Let's go to the green today. Energy Fuels gaining close to 11% today, and it's up 207% over the last year. It ended the day at $25.42 a share. Lithium Americas moving up today, close to 10%, a gain of 64 cents a share. And then Endeavor also gaining, Endeavor Silver gaining 8.6% or $1.07 per share, taking it to $13.48. Let's go to Bloomberg's equities reporter, Stephanie Hughes. She joins us now with more on the movers. Stephanie, investors looking to precious metals, face of more uncertainty, geopolitics. Tell us more about who gained.
Absolutely, Marella. So Endeavor Silver is the one that I focused on to get at that precious metal story. That stock gained by nearly 16% at its highest point, which was the silver miners' biggest intraday move since October. It was also for most of the trading day at the top of the TSX best performers before it was taken over by the other two names you mentioned earlier in your stock movers piece there. But it was also enough of a move to bring the stock price to its highest level since October. And And Endeavor, like you mentioned, rising alongside other precious metals names today after spot gold prices rose by nearly 3% at their highest point, with prices topping $4,455 an ounce. And then meanwhile, silver gained by about 6% at its highest point. So precious metals, like you said, gaining because of the Venezuela story that's top of mind for everybody trading today. And they're really gaining as a safe haven play after President Donald Trump said the U.S. plans to run Venezuela after ousting President Nicolas Maduro over the weekend. So that news over the weekend really ramped up geopolitical uncertainty, especially after Trump repeated that the U.S. needs Greenland for national security reasons. So this is a fresh burst of geopolitical tensions that's not only moving Endeavor Silver higher, but other TSX-listed precious metals miners, including Silvercore Metals, First Majestic Silver, Nova Gold, and many others, Marella.
Okay, so the same trigger, as you mentioned, the movement in Venezuela, some moving to metals, but also played out on the oil sector today, moving in the opposite direction. Athabasca took a big hit.
Athabasca took a really big hit. Yeah, so it was down by 10% at its lowest point. That was its biggest decline since last April. So unsurprisingly, like you mentioned, this is also tied to the Venezuela story, as Canadian energy stocks are just broadly hitting a rough patch after the U.S. Captured Venezuela President Maduro. And it's sparking some concerns among traders that Canada could face more competition from Venezuela for oil exports to the U.S. Looking at some analyst reaction, RBC analyst Greg Pardy said that the U.S. is taking control of Venezuela's oil sector presents a longer-term structural risk for Canada's heavy oil export market, I should say. He also noted that the what he called the knee-jerk equity market reaction could put Canada's energy producers under some more pressure. So that's what we're seeing today. It's really been a dynamic of metals names were up, oil names down, and it's not just Athabasca that I'm picking on here. It's also other oil and gas names like Parex Resources, Canadian Natural Resources, Cenovus Energy, and others, Marella.
All right, Bloomberg Stephanie Hughes with the watch on a Monday. Thanks for that. Let's go to mover south of the border with Bloomberg senior equities reporter there, Bailey Lipschultz. Bailey, we looked at Canadian oil stocks. They are down today. You heard that. Fill us in on what happened for the American oil sector.
Quite frankly, the exact opposite for the most part. We saw big rallies for the likes of Chevron, Exxon, and a number of other U.S. oil majors after that news. And partly this was seen as the potential benefits for U.S. Producers and midstream companies. As you can see, these are big gains, biggest gains for a number of these companies since really tariff day in 2025, so going on about 8 months. And the big expectation is you look at that big rally for Chevron up more than 5%. They're the only U.S. major that operates now in Venezuela, so they are seen as having first mover advantage. The big question is, what does this actually mean in the long term? How do changes, if they are implemented, impact some of these companies? President Trump said in an interview today, basically, that some of these oil companies knew about the attack and kind of the expectations around what this could mean. So the big question is, what's the long game? But obviously Wall Street likes to kind of ask questions later. So the initial bid was for a number of those companies that at least are seemingly going to be best positioned to benefit in the immediate term, with questions on where Brent and crude oil are trading kind of further onto the horizon.
Okay, let's get to shares of QXO also moving today. What's driving that?
This is a big rally for a company that basically is Brad Jacobs, who's a billionaire, kind of his new model to roll up companies. So Apollo agreeing to lead an investment that was $1.2 billion as a building products company. They're kind of continuing to buy companies. They had a big deal for Beacon that closed last year. And kind of the big question when you look at analysts is, what does this future mean? As you can see, top pick at benchmark, but we did see a number of Wall Street analysts kind of weighing in and pounding the table that this big investment from the likes of Apollo kind of lends validation that they are going to continue to be acquisitive, and whether Brad Jacobs can continue to roll up some of these companies is kind of the bet on the future. If you look at the stock, this did have its best day since it really started trading in July 2024. I say really started trading because it was a pretty wonky structure with a reverse takeover of sorts and then shares being unlocked. But the big thing you need to know is an 18% rally basically puts the stock trading around where some of those preferred shares will be invested by the likes of Apollo. And again, is really a bet that there will be at least one big acquisition for the company this year as it continues to roll up companies.
Okay, let's get to United Rentals. What's happening there?
Yeah, this is a company that rallied this morning and throughout the day on the back of an analyst upgrade to buy equivalent. And the big bet, when you look at United Rentals, what this company actually does, it leases out and rents things like forklifts and jackknives, other industrial tools. And the big kind of bullish takeaway from UBS on that is that the construction market here in the U.S., non-residential construction spending from them, they estimate that there will be 4% growth this year and 5.5% growth next year. This came after a 1% decline in 2025. So a bullish view from UBS on that upgrade. As you can see, still not near those highs that we saw late in the fall, but a really strong day, best day in a number of months for United Rentals, and really a standout again in a day that kind of had its fair share here in New York of winners and losers.
Bailey, thanks for the update. Appreciate that. Up next, U.S. markets close higher today, driven by the gains in the energy stocks as part of it, following Maduro's outcast and now in New York facing trial. We're back in a moment. Stay tuned. Start of a new year. My next guest believes it comes with opportunities to invest in high-quality companies that have been lagging. Let's go to Chad Morganlander, Senior Portfolio Manager at Washington Crossing Advisors. Thanks for joining us today.
Thanks for having me.
You say Gambler Nation has been in control of the financial system. Can you explain what you mean?
Well, we have credit spreads that are so tight, and you have more of a speculative excess within the financial system. I know everyone is focused on the Mag 7 or the top 10 companies or 20 companies representing roughly 50% of the S&P. But really what you've seen is many companies that don't even have any profits nor revenues that outperformed quite a bit last year. You're seeing that on the speculative fringes regarding options, as well as you're also seeing it in many of in the world of cryptocurrencies. That doesn't mean that Bitcoin may not be viable, but overall you have more of a speculative fervor within the system.
Okay, so do you have greater concerns about the market?
I do. In fact, when you go and you look at 2025 and you look at the total return of the S&P 500, out of the 18% of the total return, 17 of it came from companies that had market betas above 1. So we would be somewhat more balanced within our investment stance. I would be moving up the quality spectrum, in particular on the fixed income side, because high yield bonds really aren't giving you that great of a opportunity here. And you just want to just be able to pick and choose and be investing in more of those profitable, higher quality names that have more durability to them.
Okay, you also say, Chad, that people should question AI investments. And we know some of that started late last year, but what should they be asking about?
You have a gigantic amount of global capital investment that is being pushed towards an incredible technology. So Washington Crossing Advisors truly leans into artificial intelligence in a big way, but you're going to have a misallocation of capital. As technology evolves, it may be under question if you really need that many data centers. In fact, 40% of the data centers that are being created in the United States are being done by hyperscalers, the likes of Microsoft or Alphabet, that are well funded. But there is an additional 60% of projects out there. Compute. There is a substantial concern that there's not enough compute. That's why they're building these data centers. But the price of compute may fall precipitously, and the assets when it comes to depreciation, that's one that may have to be questioned in the long run. So as a portfolio manager that's looking at businesses, we want to be mindful about what the viability of that business will be for 5, 7, and 10 years. And you just want to just be very careful when diving into the artificial intelligence companies and their adjacent companies that have outperformed considerably over the last 2 years.
Okay, so let's get to some of the names that you like. Visa is the first one, and Visa was lagging in the second part of the year. So what do you like about Visa this year?
So the multiple has been compressing for the last 5 years. This is a growing company. It's going to grow with global consumption. Yes, consumption patterns have decelerated, and we believe that they will perhaps start to kind of hit their equilibrium and go higher a bit in 2026 here in the United States. And we do believe potentially that will happen globally. We don't believe that the moat, that they have a protective moat, and that we believe Visa and their competitor over the next 5 years will do quite well. So it's growing, profitable, very little debt, rising dividend story, multiple that we believe has contracted, so it's more justifiable to buy this company and put it as a core holding.
Okay, let's get to your next pick, which is, again, in the tech sphere, but not centered on some of the bigger moves everybody has been frantic over. IBM is what you like.
Okay, so this company is perhaps one that the investors are looking at this as one of the victims of AI. We believe that their actual lines of revenue are going to get a massive jolt higher over the next 5 years, whether it be from their consulting business or their Red Hat Linux side of their business, which software represents roughly 45% of their business. When it comes to AI and it comes to their mainframe business, there are smaller models that can run on their mainframes with power consumption at a fraction of the cost of what typical hyperscalers are doing. And as well, the data security there is quite robust. And then lastly, when it comes to AI, and this is kind of a lotto ticket, but the quantum computing side of their business, they're front and center, and you're getting it at a reasonable price, albeit it's not extremely cheap. But if you're going to be in this world of artificial intelligence and compute, this is the one I think is the most conservative way to play it.
Okay, I do want to get to your last pick here, which is Cisco Systems. Tell me about why you like Cisco.
Well, their bread and butter business, which is routers and switches, there's going to be a massive campus refresh over the next 3 to 5 years because of artificial intelligence, because you need to kind of run these businesses on the leading edge of technology. They do have a security side of the business that's more of a reoccurring revenue side. That security side has decelerated a little bit. We do believe that, of course, is going to increase and do quite well. And then lastly, when it comes to data centers, they do supply into the data center side, and in particular when it comes to the sovereign side. So you're getting this company at a pretty reasonable multiple, at an enterprise value to EBIT of roughly about 15 or 16 times 2026. I think it's just a very conservative, more attractive way of playing this whole data center build out. And it's also, we believe, even after this boom and potentially deceleration occurs, that this is one that can be quite, can take advantage of not only that, but other things within the AI complex.
Shad Morganlander, got to leave it there. Thanks for joining us on the program. Appreciate it.
Thank you.
Coming up after a break, we'll take a closer look at copper. The commodity is seeing record highs. More in a moment. Copper has reached $13,000 a ton for the first time, but mine outages and trade dislocations fuel concerns about supply. We got more on this from Chris McCaney, Executive VP, Head of Investment Management and Strategy at Global X.
We have, of course, significant demand for copper. We already did with things like energy transition, electric vehicle build out, things like that. Of course, electric vehicles require a lot more copper than traditional vehicles do. And so when we had things like EVs being built out, you had wind and solar coming online, a lot of demand for copper in order to build out that network. And now we have new demand, really, or newer demand from data centers and the build out around AI. And of course, that AI infrastructure is causing a lot more demand for copper here right now.
And I was looking, the U.S., I think, holds roughly half of global inventories, but they only use 10% of the world market copper. Are they cornered, or are they just holding on to it for needs coming up, expected needs coming up?
Yeah, I think a lot of this comes back to the tariffs, as you had mentioned. Earlier in 2025, there were tariffs sort of threatened on the copper market. That caused a lot of U.S. companies to hoard as much supply as they could. Now, those tariffs ultimately didn't come through, but there is uncertainty as to around if new tariffs will be implemented. And so, as you mentioned, U.S. companies really holding on to a lot of the global supply out there right now.
So, and as that drops, that supply, can we see copper prices dropping too?
Potentially in the short term. We do think long term there is still a structural deficit of copper supply. And so as demand continues to increase over time, of course, it takes a long time for new supply to come online. We think that provides a floor to copper pricing going forward. Just looking at S&P Global, they're predicting copper demand is going to increase, call it 66%, maybe about 2/3 in the next 10 to 20 years, and potentially even more as you move that time horizon out. And so, really from the demand picture, nothing really slowing down from that side of things. And so it will be incumbent on finding new supply and bringing new supply online in order to ease those prices.
And that takes a while. There's also concerns going on with the strike. How much of a factor is that right now down at the Capstone mine in Chile?
Yeah, really, you talk about a strike. There's also been some closures of some mines as well due to safety concerns and incidents at some mines. And so all of this is having a big impact on the supply. Again, demand continuing to increase, supply actually constrained, not just from new supply not being able to come online, but as you say, some of these mines being closed for various reasons, meaning existing supply that we thought was there is not coming out of the ground for any time soon.
Do we see more? I mean, part of the reason, from what I understand from the strike down at Capstone, it's on. They say, hey, look, copper's at record highs. We want a piece of the pie. Is there murmurs and rumors of other mines seeing similar situations?
Hard to say, really. In terms of where copper is globally, it's very dispersed. Of course, concentration in Chile and Peru in South America, but also China, Russia, Australia, others have a lot of supply as well. So really it is dependent on each of those markets. Of course, labor issues are different from region to region as well. So, we don't think that's going to be a huge concern going forward. But again, anything that constrains supply is going to have some sort of upward momentum on prices.
And what other things are you keeping an eye on when it comes to copper?
Well, the U.S., of course, at the end of last year, adding it to their critical minerals list. So this isn't necessarily even just supply and demand now, it's geopolitics. And so a lot of countries, and of course the U.S. very symbolically, by adding copper to its critical minerals list, is indicating the importance to national security of containing and having a copper supply and supply chains that go into the country. And so you'll probably see other countries look to do this as well. And it's going to create a global arms race to keep that copper supply within domestic borders.
I guess the big one for that is China. It feels like it's been quite quiet, actually.
Yeah, that's right. We haven't heard much out of there. It's really been about, some of these disruptions that we've been talking about. Of course, we know China is forging ahead with AI as well. In terms of that build out, there's really an arms race there also. And so again, going back to that data center requirement and that compute requirement requires a lot of copper for that. And so you can be sure China will be needing a lot of that as well.
Chris McHaney is with Global X. Coming up next, Maduro pleading not guilty during his first court appearance in New York after being captured by American forces on the weekend. More in a moment. Here are the stories we are following today. Nicolas Maduro pleading not guilty to U.S. charges in a narco-terrorism case 2 days after being captured along with his wife in Caracas. Maduro was escorted in front of a federal judge today in Lower Manhattan to face the charges, but it could take years before the legal wrangling leads to a trial. Maduro says he was kidnapped from his country. U.S. oil stocks closing higher today. Chevron, ExxonMobil, and ConocoPhillips surged on expectations of expanded access to Venezuela's vast oil reserves. The U.S. president says American companies will invest billions to rebuild that country's crumbling infrastructure and revive its energy sector. Now, a different story on this side of the border. Canadian oil stocks closed lower on the day. Investors worry that a shift to Venezuelan oil could put pressure on Canadian heavy crude prices. U.S. gold and silver also closed higher following the news surrounding Venezuela, with more geopolitical uncertainty triggering the buy. Gold is coming off its strongest annual performance in decades, supported by central bank buying and expectations for more U.S. interest rate cuts. Back in Canada, Greater Vancouver realtors reporting home sales finished the year down 10%, the lowest annual sales total in over 20 years. Sales totaled over 23,000 in 2025, a 10.4% decrease from the year before. But despite that, sellers brought the highest total of listings to market on record since the mid-1990s, eclipsing a previous record high in 2008 by a little over 1,000 listings. Okay, let's talk about geopolitical implications of what happened in Venezuela with Nicolas Maduro captured and now in American custody. Marco Papich joins us now. He's chief strategist at BCA Research. Thanks for joining us today.
Absolutely. It's a pleasure to be here.
This kind of raid is rare, especially when it's done as cleanly as it seems to have been done on the weekend. What allowed this to happen the way that it happened?
Well, I don't know for sure, but I think that it's very likely that the U.S. had very good intelligence, and that suggests that parts of the regime, maybe even the majority of the regime, was in some way implicated in this operation. So somebody very close to Maduro would have had to track the movement of the president and also give the U.S. a very clear indication of where the air defense systems were, but also where the close range, fire would have come from within the compound itself. And that's a level of detail that suggests that members of the regime were definitely not surprised by the event.
Yeah, definitely they knew where he was, but also where his wife was at the same time, because they clearly wanted to get her as well.
For sure. Yeah, the whole thing.
Okay. How does what happened on the weekend compare to past attempts to take a leader from their country?
That's a really interesting question. I mean, 1989 comes to mind. Late 1989, early 1990, George H.W. Bush administration went after Noriega, president of Panama. That required a 2-month operation. 23 American service members lost their lives in that operation. And then finally, Noriega surrendered to the occupying forces. You can also talk about, for example, the 1999 NATO attack on Serbia. Although it wasn't overtly designed to remove Slobodan Milosevic, that did happen the following year in October of 2000 in a domestic unrest, which was partly produced by the attack itself. So we have literally never had anything as clean, efficient, and successful as what just happened in Venezuela.
Do you see this as an attempt to take the supply chain of drugs offline, which is what Washington is saying they're trying to disrupt drug trade? Or do you see this more as a security matter? And if you do, how does Venezuela play into that?
I think it's all of the above. It's also oil reserves for sure. It is an opportunity for American corporates to have an easier access to Venezuela. I mean, President Trump has openly said that. So it's not like Marco Papich thinks that. President Trump has literally said, America built this industry, we want it back. I do think it also has to do with removing Russian and Chinese influence, and also absolutely with some of the drug transshipment and also immigration. My concern is that the operation was so successful, so astonishingly successful, that I wonder whether President Trump is going to feel that he should repeat it, rinse and repeat in other parts of the world. And I think that that's something that the market is starting to price today in some of the market action you've seen, particularly with gold and oil.
What's your impression of how this is playing in the U.S., with the GOP as well as in Venezuela?
Well, I think in the U.S. it's going to play largely in favor of President Trump, provided, again, that further attempts for regime change either don't happen, or if they do happen as astonishingly brilliantly as this one. So the danger here for President Trump is that he may be riding a high right now that he feels compelled to repeat somewhere else like Iran, and then it turns completely differently. Now, I think ubiquitously, most American commentators are struggling to find ways in which to criticize this. I mean, President Maduro was not a nice guy. The Chavista Maduro regime was objectively, measurably one of the most vile regimes on the planet. So removing Maduro from Venezuela, there's very few things to criticize about that. The problem for President Trump is that midterm elections, even general elections, don't really get decided on foreign policy. And so while he may bottle up this success and run on it in 11 months, I'm not sure it's really going to make much of a difference. American voters are still really saying that the economy and inflation are the number one concern, affordability. It's not whether Venezuela is run by a slightly more pro-American dictatorship.
Okay, picking on a couple of points you brought up. One, the confidence that comes from carrying out a military excursion like this one and coming cleanly away with the leader in American custody. But as you said, Maduro was not a well-loved leader even by his own people. Trump's already brought up Greenland and what he wants from that country. Do you think that is a serious threat? And if that is carried out, what does that look like as far as ripple effects through the world?
I mean, that would be, as the Prime Minister of Denmark has said, it would be the end of everything. That was literally the words she used, and I agree with her. Attacking a staunch ally, and America has many allies. There are many, many countries that are members of NATO, but not all of them are equally as allied to the U.S. Some are staunch allies. And Denmark, in particularly Denmark, has been an incredibly staunch ally of the United States, even in comparison with other NATO member states. So if you were to invade a territory that is part of Denmark, that would be truly a breakdown of all norms. It would be a very serious event. And I think that the probability of that actually happening is very low because it's so shockingly a break with reality of the last 80 years. However, even just mentioning it forces investors, forces markets to start pricing in this breakdown in norms of behavior by large, powerful states. And in particularly, what I think is happening in the markets today is what I've called the age of empires premium, which may fly over some of your viewers' heads who are not computer gamers, but there's this computer game called Age of Empires where you send out your little villagers to cut timber and mine for gold. It's basically a resource-based strategy where you have to hoard resources. We have not lived in that world for 30 years. For 30 years, you were able to extract resources in Canada or Greenland or wherever and sell them on the international markets. But when you have the President of the United States of America talking about how he needs Greenland, that is going to incentivize many other countries to start hoarding critical natural resources. And I think that could lead to quite a parabolic market action, particularly with industrial metals, which have already been in quite an interesting bull market for most of 2025.
Yeah.
It's not that anybody actually thinks America will invade Greenland. But when that kind of behavior is becoming more acceptable, then yeah, you will need to start hoarding industrial metals and other commodities just in case certain supply gets taken off the market by an action like we just saw over the weekend.
Okay. Marco, got to leave it there, sir. Thanks for your time. Appreciate it. Coming up next, emerging markets among the top performers in 2025, but increased volatility with policy changes raises some questions about what is ahead in 2026. More in a moment. Emerging markets ended 2025 with strong gains, surpassing major Wall Street averages after significant policy reforms in the U.S. Let's discuss the outlook for 2026 with Hadiza Jatow, Vice President, Portfolio Manager, Mackenzie Investments. Thanks for joining us today.
My pleasure. Thanks for having me again.
What were the main drivers of the strong performance, would you say, last year?
It's mainly U.S. dollar weakness. Fed also delivered a couple of cuts that really led EM assets across the board to outperform. If you look at EM local rates, for instance, performance ranges to anything between 15 to 25% when you account for FX appreciation, but also rates coming down as central banks, especially in LATAM, continue to deliver rate cuts. I do believe that we can see that rally really further extend into 2026 because many of these drivers are still well alive. We expect the US dollar also to weaken in 2026, while Fed might not necessarily cut as much as the market is pricing today. Even a stable policy rate in the U.S. is still good for EM. And I would say the one of the key drivers that have changed over the past 48 hours is going to be obviously U.S. geopolitics. The Venezuelan intervention that we've seen is, in my view, a strong signal in terms of engagement of the U.S. within LATAM country in particular, given how much the U.S. are willing to have supply chain access, focusing on resources, focusing on access to energy, and those countries obviously will play a key role in that objective.
I was going to say, is that a good thing or a bad thing for some of these markets?
I think it's a very good thing. I think from two perspectives. First one, obviously, is the economic growth that is going to be lifted if we see more resources being tapped into these countries. But also think about a country like Argentina, where the U.S. earlier last year came in and started buying Argentinian peso on the market, offering a clear backstop and really reducing the tail risk that was embedded with Argentina. As we know, Argentina is a country with a ton of resources, had everything to succeed, was in the 1900s amongst the top 10 richest country in the world, but now is almost at the brink of bankruptcy. All that because political regime instability led to poorly run country while resources were all there. And now with the U.S. backstop, markets are now coming back and reconsidering investing on the longer term in these countries. And I think this is obviously a strategic change. It's a significant shift, and that would see more and more FDI and more assets going into EM countries in general, but I think in particular LATAM is well placed.
So Hadiza, when you're looking at an emerging market and their growth prospects, what do you take into account?
You have to take account a few things. The first one, obviously, is exports, how much of this country are able to export. And I will really put them in two categories. You have what I would call the one-trick pony country. Let's take Nigeria as an example with oil. All they do is exporting oil, but that oil is not necessarily supporting growth organically within the country. If you take Argentina or Brazil, typically those countries are somewhat closer to what we'll see, let's say, in Canada in terms of the structure of the economy and the ingredients that are needed, not only to support growth from a resource perspective, but also having a highly educated population that helped increase productivity in the country so that we create sustainable growth rather than exporting just some high value resources externally, but then the level of development in the country is really stalled and not necessarily moving the needle, despite the capital that are coming into the country from the resource perspective.
Okay, your top picks for 2026, one of them is Argentina, and you stated sort of what you see there as far as strength goes. What about Brazil?
I was in Brazil and Argentina back in November, spent 2 weeks there, met with officials, central banks, governor, and also investors in place. I would say my top pick are Brazil, obviously. Brazil is one of the highest yielder in the world. If you look at rates, you can be paid 15% all in or 9% after inflation, which is really a very, very significant carry. I do believe that the upcoming elections with Lula somewhat being questioned and see maybe the pendulum swing toward the right, we'll see capital inflows. What we've seen so far in EM is more, let's say, fast money. And that's exactly what we saw in 2025. Hedge funds, maybe short-term investor, but actually long-term investor, long-term allocators are not still in the pace. And we can see that it is still underinvested. And I believe that that given how much stocks have done well in 2025, some of the excesses we saw, especially in US stocks, tech stocks, AI, that concentration could lead some of the long-term investors to reinvest towards diversification, and that would mean really some form of a tailwind also for EM.
Okay. Sorry to interrupt you. I do want to get an idea of markets you think investors should stay away from.
Market we should stay away from, I would say, as it stands, would be Eastern Europe. I do think that Eastern Europe, in terms of valuation, doesn't necessarily offer as much. And given the proximity, obviously, with Ukraine and all the changes in going into Europe, I wouldn't necessarily be positive on Eastern Europe, but definitely on LATAM, Argentina, and also Brazil.
Okay. Hadiza, I'm going to leave it there. Appreciate you joining us today. Hadiza Chatal, Vice President, Portfolio Manager, McKenzie Investments. Full steam ahead for 2026. After the break, some mega trends to watch out for. We're back in a moment. We are at the start of a brand new year. We were joined by guest co-host On the Street, Jeff Hull, Senior Financial Advisor, Manulife Wealth, and he gave us some mega trends he predicts for the market for this year.
Well, probably the biggest influencer will be Donald Trump. Big surprise, same as last year. Again, not just his politics, which can be very acidic, but you got to watch his policies. And you got to remember, too, the most important thing for Trump, and we can rely on, is his ego. He wants to go down as one of the best presidents of all time. So he needs to win the midterm elections coming up in November for the House of Representatives. Republicans currently, as you know, control the White House, the Senate, and the House.
But it's being
the
House is pressure right now.
Exactly. So the House could flip Democrat, which historically that's usually what happens in the midterms. It flips. But if Trump wants to keep the House with the Republicans, he's going to have people feeling a lot better about inflation, the stock market, business, lower taxes, but also with some extra walking around money in their genes so they could feel a little wealthier, so they would want to vote back in a lot of the Republicans. Otherwise, Trump's going to spend the last 2 years of his presidency impeach, all the way along the way, and the Democrats will likely zip up the purse strings that they have control over the U.S. government for.
So what do you see him doing with policy-wise, and what kind of an impact you see that having on, well, everywhere else, essentially, but Canada especially?
Yeah, I think actually even just going back to traditional politics, and he proved this, and even on BNN I talked about this when he first got elected, is for the first 6 to 9 months of his presidency, he was trying to enact 6 years worth of change. He was going to break and bruise relationships, even when he did the 74 tariffs around the world. It's like a hockey guy dropping the mitts on the ice to fight the whole other bench at the same time. It's like, is he in that much of a rush?
He's a big guy.
Exactly. But he had to be, because he had to get that out of the way. All the bitter medicine, this is what all politicians do. Dole out the bitter medicine early in your election and when you win. And as you get and draw closer to the next election, start to be the good guy. Start to hand out candy to everyone. Not be so bad. Again, more walking around money in someone's jeans makes people feel a lot better about re-electing that government as an example.
All right, AI.
Love AI. Can't get enough of it.
So you're bullish on it, I'm going to guess.
Yeah.
It does seem like this will be the year that we might see a lot of fruition when it comes to AI. Companies really taking advantage.
Yeah, I think it's going to be exponentially accelerated. I've been an early investor in NVIDIA for over a dozen years. I love NVIDIA as a company, but also the whole AI framework and space is tremendous. There's going to be a lot of efficiencies that are created for companies, industry, governments. But there's going to be a lot of dislocation and displacement for a lot of employees that may have their jobs terminated by this new AI technology. So that's one of the negatives of AI. But overall, for science, medicine, health, physics, space, all the way around, AI is only a good thing that way.
Now, I mean, traditionally, when there's been disruption and there is always a fear that jobs are going to be lost and never replaced. Usually more jobs are created than were destroyed. But for AI, a lot of people think this isn't the case because we may destroy a whole lot of jobs.
Well, we can always oil robots, right? So that's a
job for you.
But the
code, right?
Yeah, exactly. But the reality, actually, even AI can now do the coding, which is you just need a human for the initial inspiration. But you have to remember, there were no such thing as an auto mechanic before automobiles. There was no such thing as certain types of engineers until that was needed for certain things, certain technologies, as an example. So throughout history, whenever there's been a dislocation, disruption, innovation has come in. I always say the Stone Age didn't end because they ran out of stones. It's because there's new innovation and new technology that comes in. So I think AI is a great one. But another one actually aligned with that is the robot revolution coming in. And not just the robots we know of that do assembly lines, the Canadarm on the space.
The ones that dance and things like that.
Oh, it's creepy how they dance better than I do, and I don't dance very well, but it's tremendous. But the humanoid ones are really taking hold. They're not just Teslas, but you got General Dynamics and all these other ones, and also for military. You know, even this military situation in Venezuela, this mission that went on that was flawless. Imagine if a lot of it could be done by humanoid type of robots. Where you don't have to have that. A lot of the F-35 fighter jets used actually drones, AI drones beside them.
Yeah, they sync up with it, right? And they fly as a
They fly
unit,
almost like a trio,
cohesive.
but there's only one pilot. So it's amazing technology, what AI can do, robotics can do, and even autonomous cars for the future as well.
Okay, so it's all glorious, but there are also some things to watch for.
Yeah, there's some negative things out there as well. I think one of the biggest problems investors have, number one, is their own emotion bouncing between fear and greed and fear and greed. People have to have a plan and work the plan. People don't plan to fail. They just fail to plan. So they have to kind of figure out and have a kind of a torture-proof or storm-proof portfolio. I always say predicting storms doesn't matter, but building portfolios like ARCs is. You don't have to predict the storms, you got to endure the storms. So people need to be ready and know what they actually own. But one of the biggest dangers I see, and I do a lot of work with the NHL, and I find that when I take on a new client, a lot of them may have private equity or private credit, which are these kind of funds that lock you in almost like a prison for 10 to even as long as 15 years.
And I'm sure they seem like a good idea at the time.
Yeah, because they'll point to something inside the portfolio and go, look, SpaceX. And people go, oh, I want SpaceX. But don't say, oh, the rest of it's all turds inside that portfolio. So it's difficult for investors. But the biggest problem I see now is starting to be reminiscent of the 2008 Great Recession, is around gold, silver, and certain commodities where all these private equity and private credit funds out there own paper promises that somewhere down the line you own gold bullion or silver bullion. So I think investors have to be cautious and know what they own. And if they are going to go down that route of commodities or buying gold or silver, if you're not going to own the actual direct metal where you can actually hold it, then buy a fund or something where you know that it's audited and they actually control 100% in the vault of what they claim to have. Because there's this whole parade of these paper promises. Many can't back the amount of gold and silver. There's too much paper out in the world for the amount of gold and silver that's ever been mined. So that's a danger point people need to watch out for.
Jeff Hull is Senior Financial Advisor at Manulife Wealth. Here's a recap of how we ended the trading day. The TSX Composite hit another record close today, moving up 336 points, move over 1%, ending the day at 32,219. Green for the S&P 500, it gained 43 points today. And then the NASDAQ, 160-point move up, 0.7%, ending the day at 23,395. A quick look at some of the movers for the day. U.S. oil stocks moving higher today after the weekend capture of Nicolas Maduro, the leader of Venezuela, and his wife. He's been brought back to face federal charges in the U.S. now. So the question is, what happens to the oil in Venezuela? People are liking the oil companies in the U.S. ExxonMobil gaining 2.2%, move of 271. Chevron gaining. ConocoPhillips also gaining today. A different story in Canada. The oil here, much of which does go to the U.S., stocks dropped. Athabasca Oil down over 7%. CNQ, Canadian Natural Resources, down over 6%. And Cenovus down more than 4%. Thanks for joining us today on The Close. We'll see you back here tomorrow.